In this week's update, on January 1, where did you expect the S&P would be? Another non-correction rolls through and precious metals continue down. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. All right, let's just start with an overall perspective. The reason I'm posing this question this week is that for the umpteenth time this year, the media is, I guess, trying to scare us into doing something, anything, to get out of the way of the market crash that's coming. And when you look back and take a bigger picture perspective, it becomes really obvious that sometimes trying to avoid the damage is actually the worst thing that we can do. And I just ask you to think about how many times during this last year did the media narrative scare you? I know it concerned me a few times, but because I've got a pretty robust process, that was able to get me through that period of indecision. And if we look at the S&P, it's gained 18.6% year to date, which, given the environment we've got with ongoing issues around COVID and lockdowns and when we'll get back to normal and China and all those things, really does seem like a pretty good effort for the year. Now, there were dire analyst predictions on Monday and Tuesday of this week to do with the Evergrande situation in China, and also what would the Fed do with tapering and raising interest rates. And that really marked the bottom of this mild correction, it would appear. Now, other things can still intrude, but at the moment it would appear that both those big issues are now pretty much off the table. And what is obvious from the economic data is that the US consumer is alive and well, and we'll look at the key sector ratios to confirm that. But just to start, let's just look at a big picture view of the S&P. So I've gone back here to the start of 2018, and then the S&P was at 2,680 points. Move on to the start of 2019, the index was actually lower. It was down at 2,450. By 2020, we were back up to 3,225. And then we then had the huge COVID crash. And then at the start of this year, we were at 3,765, and we've just closed at 4,455. So when we were at the start of the year at 3,765, honestly, who thought that we would have been at 4,500 on the S&P, given what the tunnel we were looking down at the time? And the reason that I think this time frame is relevant is that in 2018, we had two significant corrections. One just after the start, and certainly one at the end. So the last quarter of 2018, when Jay Powell was talking about the Fed moving more aggressively on interest rates. So we had two significant pullbacks. We then, of course, had the crash in the start of 2020, and now we've had a significant rise. So if you look at that 4-year period, it's not quite 4-year period. It's not that atypical of what we get over similar 4 to 5 year periods. And yet, from 2018 to the current point, year to date, with still 3 months to run, the S&P has gained 40%. Now, if we got a repeat of that performance into 2024, then that would have the S&P at 6230. Now, it seems like a long way away, but you've got to ask yourself, well, why not? All we'd be doing is just duplicating what we've been through, and you can hardly say that the last 4 years has been easy going, because it hasn't. And then if you extend that thinking a little bit further and consider, well, where could the index be in 2030, given that we were in a secular bull market, of which there is really no question? So anything is possible, and it raises the question then, when the media is, I guess, trying to scare you in the short term, what should your response to that be? How good is your strategy? And how much do you tend to react to the media? And the clearer your game plan is, the less you are going to react to the media, and the more that you can leave yourself exposed to these sort of trends. And this is just the S&P. This is the overall index, which has got, the good, the bad, and the ugly. What if you then got focused on the mega trends, the sectors that are doing really well, such as decarbonisation themes in all its various forms, or biotechnology? How much better could you do with a really well sorted out game plan? So I think a very interesting perspective to reflect on the next time that there's some sort of short-term concern about where the market might go. So if we zero in and we look at the S&P, you can see we did have a little bit of a disrupted period over the last few weeks, but that's fairly typical of this time of year. This is fairly typical of September. But you can see quite a strong rise on Wednesday, Thursday and Friday, and we're now back above the 50-day moving average and almost back above the 20. The moving averages are all stacked up in the right order. The price is almost back above all of them, and the market rolls on. Another correction that was supposed to occur that has really turned out to be not very much at all. So if we look at some of the sector ratios that I look at every week, so this is the Russell 1000 growth stocks versus value stocks. So this is essentially large caps, and it's really probably pretty much in balance at the moment, but certainly towards the upper end. So that chart is still pointing to bullishness in the market. If we look at the small caps, so the same ratio, growth versus value, but in small caps, a little bit of a turn down on Friday, but that's neither here nor there. The direction since the lows that we saw in May is clearly to the upside. And if we look at, there's the other one I'm looking for, that's consumer discretionary versus consumer staples. No question, consumer discretionary, which is a sign of confidence. It's a sign of strong economic performance, and it's a sign of bullishness. So the consumer discretionary is still outperforming consumer staples. So that is how the market is orientated. No matter how you want to slice it and dice it, that is what the market is telling us at this point in time. So looking at the actual results for the American market, the S&P ended up rising 0.5% for the week. After all that, there was a little bit of a wobble, but that was it. Now, one of the seasonalities that does play out pretty reliably leading into the couple of weeks leading into earnings season, and we've got another earnings season coming up in America in about 2 to 3 weeks' time. So we can expect technology stocks to repeat their normal performance, and that is with added strength into earnings season. So Wall Street is starting to price in the better results, above expectation results that they think are likely to be coming. So don't be surprised to see technology stocks do well in the next 2 to 3 weeks. The US dollar was up again, just inching forward up to 93.3. The yield is on the rise. Now, some people get concerned about that and think that means that interest rates are going up. But what it also reflects is that we've got a good economy in America. And in a good economy, naturally, the yield is going to rise because bonds are being sold. People are going into a more risk-on environment. And the VIX, which got up to about 28 the week before last, is now back to 17.8. So things are certainly calming down in America. Turning to Aussie stocks, our dollar is back down to 72, obviously with the currency effect. Our index was down 0.8% for the week. It was the major miners that got absolutely slammed, 20% off their peak with the iron ore price, and what's happening with BHP is obviously weighing on that sector as well. Now, the iron ore price has halved. and then we got a spike on Friday. I think it was about a 15 to 17% move up, but that's just a bit of a counter trend rebound that's always going to happen. More downside is likely. I think it's likely that iron ore now is going to settle at somewhere under $100 a tonne. So that's the outlook for our materials sector. So let's look at some of those charts. I'll just check in on the there's the US dollar. So we've just sort of stalled here at this triple top, but with certainly got higher lows, and we're still in the game for higher highs as well. So clearly the likelihood is that we've got an uptrend in place and we're going to break out above this 93.5 level. So it would appear the US dollar is in uptrend. And that's of course going to weigh on the Australian dollar, which is still in downtrend. But if we turn to our market, this is a materials sector, so largely BHP, Rio, Fortescue, and the like, and we're well down from the peak which occurred at the end of July, and that's all down to the iron ore price. Now, if we look at the small caps in Australia, they're still looking pretty buoyant. The 50-day and the 200-day moving averages are still moving up very nicely. There's really been no disruption. We got a little bit of downside below the 50, but that happens quite regularly. It's happened 4 or 5 times in recent months. So the small cap area of the Australian market is still doing pretty well. Here's our overall index. It's probable that we'll see a bit of upside on Monday. Healthcare continuing to do pretty well. That's trending very nicely. Finance really just going sideways at this stage. And energy, which had been lagging, is starting to rebound a bit with the higher oil price. Now in Australia, battery materials stocks remain very buoyant. They're obviously pretty volatile, but the outlook is still very strong. Turning to precious metals, gold was down just a couple of dollars, down to $17.50. Silver is still losing ground on a relative basis to gold. The next support for gold comes in at $16.80, and you've got to say when you look at the charts that that's the most likely outcome. Turning to precious metals, there's really no change in precious metals. The trends are down, as we'll see in a minute. There's the Bitcoin chart while I'm here. That's with China effectively trying to stamp out cryptocurrency altogether. That's certainly not helping, and Bitcoin has come off from the low 50,000s, closed the week at the low 42,000. Precious metals, there's the weekly chart on gold. We're in a downtrending channel. We're just in the top half of that downtrending channel, so there's still plenty of scope to the downside. So there's the likely area of support in this sort of 1680 area, but it could easily head all the way down to the bottom of the channel, which would bring it down to this big picture 50% retracement area, which is around the 1567 area. So there is still plenty of scope for downside in the gold price. If we look at it on a daily basis, not a lot of change there. And silver clearly now in downtrend. You can see the 20-day and the 50-day are now heading down quite sharply. So silver leading the way on the downside. If we look at some of the ratios, this is the GDX divided into the gold price, and the long-term average, just a reminder, it's somewhere between 0.4 and 0.45. So gold stocks are cheap on a long-term basis relative to the gold price, but at the moment they're also losing ground. And given that the stocks tend to lead the direction of the metal, at the moment that's saying that we've probably got more downside. And if we look at gold versus silver, you can see the ratio is starting to rise again, which means gold is outperforming. Now, just turning to the metals miners, this is GDX. So we've now broken support on GDX. That was an important level. The moves to the downside are they're not massive, but you can see we are getting elevated volumes. Back on the 16th of September, quite elevated volumes as we tested that support. We broke support, rallied back to it, and then as it broke away again to the downside, again the volume's starting to lift again. So whichever way you look at the precious metals sector, the outlook is not all that rosy. And if we look at GDXJ, which broke support several weeks earlier before the large caps, so the small caps are definitely falling more significantly than the larger stocks, and that's how it normally occurs. But you can see that we're clearly now into downtrend. We've broken another short-term support, and potentially there's quite a way to go on gold stocks. Turning now to other commodities, copper was steady around steady to slightly higher at 4.24, and the nickel price was down fairly sharply, down to 8.67. Given the currency didn't do much, I think this is probably just a bit of a give back of the speculative surge that we saw a few weeks ago in nickel. It probably just ran too far too fast. And crude oil was up again to 73.95. So there's the copper chart, effectively flat, but nickel did come off during the week. And there's the nickel inventory. So it wasn't anything to do with inventory levels turning up. So this is pretty low for nickel. So the longer term outlook for the nickel price is still pretty strong. So to wrap it up, my final thoughts, there's just no substitute to apply a sound strategy to being open-minded, watching the charts, get rid of your biases, and just forget the rest. You know, it's so easy to get focused on things that aren't important or things that are a distraction or misleading. Just get a sound game plan, be open-minded to what's coming, respect the trends, and just shelve everything else. And you'll probably do pretty well. Portfolio analyst last week, there was a new addition to the 10-bagger portfolio in Australia. We also looked at the importance of context in fundamental analysis, which is absolutely critical. And we did look at an alternative uranium ETF as well. So it was a pretty good session. That's it for this week. There is more information on the website, and there's my email address for anyone that wants to contact me. I'll be back with you next Sunday. Cheers.